Good afternoon, everyone, and welcome to beautiful Philadelphia. Being a person from Chicago, I tell you, I do enjoy this kind of weather for sure. I want to thank Jerry Sweeney and Brandywine Realty for sponsoring this session, and obviously Bill for your time in coming out to address the group. I'm going to start and talk a little bit about the investment business with Bill, some of the trends, the opportunities, the challenges, and then we're going to segue into my favorite subject, which is leadership. And I think Bill has a number of strong points to discuss there. But on the investment side, Bill, let's start with maybe this. As many of you may know, Vanguard has been a pioneer in retail investing. In fact, its founder, John Bogle, is a legacy in that regard. I think Vanguard launched the first retail index mutual fund and was an early flag bearer for no-load funds. So I'd be interested, Bill, to get your perspective on how Vanguard today is carrying on that legacy, one of a legacy of not only innovation, but also assurance for retail investors.
Well, thanks, Bill, and again, thank you all for being here. It's just a privilege to be here. You know, Vanguard, Jack Bogle, when he started the firm in 1975, he had this idea that an investment firm should be owned by the clients whom it serves. And that was really the first big distinguishing characteristic. We were the first and only, to our knowledge, mutual fund company. And we like to say that strategy follows structure. And what's that mean? It means that everything we do has to align to this ownership structure where your investors, your customers, if you will, are also your owners. And you know that made it a lot easier for us, frankly, to sort of navigate a lot of difficult decisions over time. And that's really, when I sort of sum up what Jack meant to us in terms of legacy, you know, him creating that structure, which was a completely innovative way to organize an investment firm, really set the tone for the firm. And then, as you mentioned, we were early adopters of this idea of indexing and offered the first index mutual fund to the retail shareholder. And the story about that goes something like this. In the early 70s, some folks on the West Coast were experimenting with this concept of indexing for large, sophisticated pension funds. And Jack, who had studied indexing and was sort of paying a lot of attention to the academic research, said, you know, if it's good enough for a really sophisticated large client, why shouldn't it be available to somebody with as little as $1,000 or $3,000, as the case may be? And that's really what led to the development of that first index fund. And it's interesting, it didn't really take hold right away. It took a number of years for the idea to really bear fruit commercially, but I think it was a concept that we believed in so strongly, we just sort of kept pushing. You know, so today, when we think about, you know, all that's happened in the intervening 40 years, we have this sort of way of thinking that where we say simultaneously, it's really important that you maintain your core values, but you stimulate progress simultaneously. Right. So we're always going to follow this idea that we're, you know, client-centric and client-owned and client-first. And if you sort of expand on that a little bit to other values, you know, cost really matters in the investment equation, diversification really matters in the investment equation. You want to couple all of that with great service. Those values haven't changed. But I will say how you deliver it actually has to change. And if if you're not innovative in terms of your service offerings and how you approach some of these core values, you can get left behind. And so just in the last few years, or last decade in particular, think about the role of technology into the whole way investors are served. I'll give you a statistic. In 2000, we were managing about $500 billion, and we had 12,000 employees, 12,000 crew members, as we call them. Today, we have 15,000 crew members and $3.5 trillion. And so that scalability, if you will, is all because of huge investments in technology. So that's where you have to have this, ability to, as I say, maintain the core values, but at the same time be stimulating progress. And so that's how we're trying to think about things going forward.
We like to think in the real estate business, Bill, that we're part of the investment equation. Probably not as big a part as we'd like to think anyway. But Be interested in your view of the investment environment out there, especially given, the stock market volatility we saw in the first quarter of this year, and then, to state the obvious, a little bit of uncertainty relative to both economic and geopolitical challenge.
Yeah, so it's an interesting environment, and I recently did a webcast to our clients with our CIO on this topic, and I think by the time we were done, we had depressed everybody who had tuned in. Look, when you take a lot of uncertainty, whether it's political, economic, or any other type of uncertainty, and you couple it with what we would describe as very fully valued equity markets around most of the developed world, you will get an increase in volatility. And so that's exactly what we've seen the last couple of years. And volatility is not off the charts right now, but it's a lot higher than it was 3 years ago.
It was for a bit there, absolutely.
And part of it is with these full valuations, I think people have to get their hands around that returns over the next decade probably aren't going to be what the long-term historical averages have been. And this is, again, what usually gets me thrown out of rooms like this. Over 80 years, equities have averaged roughly 10% a year. And if you think about it after inflation, that's about 6% real return. We think over the next decade, the absolute number is more in the 5 to 7 range. And even though inflation's really low, that would mean your real returns will be lower than normal, maybe in the 3.5 to 5.5. That's a big thing for investors to get their hands around. And by the way, it doesn't mean that I'm bearish on the economy or bearish on sort of the world overall. It's just when you have these kind of valuations over a decade or so, that's roughly what you should expect. And there are other factors that you can look at. So you look at where treasuries are trading, and 10-year treasuries yield about 2% right now. And historically, the risk premium over treasuries for equities is between 4 and 5%. So everything seems to be driving toward lower returns. And so what's that mean for the investor? I think it's tough, because when you couple that with volatility, it makes it really hard for people to deal with that. But it's still really imperative that people keep investing, because if you look at cash returns and bond returns, they're also going to be extremely low over the next decade. And if you want to earn a real return in the public markets, so not in real estate, in the public markets, accepting lower absolute returns is going to be necessary.
Mm-hmm. So how would you characterize the health of the investment environment today?
So, again, it's pretty popular to, when you see this kind of volatility and with all the political uncertainty that's out there, to get pretty negative. I think the health of the investment industry is actually pretty good right now, and the health of the markets is okay. As I said, lower returns, but that happens. You go through cycles like that. The great financial crisis really did change the whole landscape for people. And again, I don't need to tell this audience, many of you had to live through it in harsher terms, if you will, than we did. Mm-hmm. And, as you know, it was kind of a product of a lot of things coming together at the same time. But a couple of the conditions that were there, in particular, if you looked at the banking system broadly, the banking system was incredibly highly levered. Right. And, the investment banks, which are now part of the banking system, some of them were running leverage in the 35 to 40 to 45 to 1 level. That gives you no cushion at all. Obviously, since the crisis, the banking system has been greatly repaired, and with the new capital requirements and so forth, there's a lot more ability to withstand economic downturns or unforeseen situations in the financial system. So I'm actually more sanguine, if you will, about the health of the system, even though we're a little bit more pessimistic about the next 10 years in terms of returns. Mm-hmm.
So besides the issue of over-leverage, are there other lessons that the financial services industry learned, and how well did they learn them, would you say?
Well, that's like the $64 trillion question right now, and you see it being debated a lot among the politicians in particular. Look, there's been a ton of regulation. So Dodd-Frank is the most extensive regulation done since the Great Depression, 2,300 pages, thousands or hundreds of new rules. and many of which haven't even been fully implemented yet. But and we could have a good philosophical debate about whether some of these regulations have kind of gone too far and we're actually holding growth down. I would make that case that I think growth would be a little bit higher overall, where the regulatory burden is not quite so great. The flip side, though, is I do think the environment is safer, and I do think the financial system is in a much safer place, and so you have to work that trade-off. I think in terms of lessons learned, I don't know how many times over the centuries we have to go through this, but excessive leverage is a bad thing. And if you look at every financial...
Did everybody out there hear that?
If you look at every financial crisis, it's excessive leverage, and sometimes excessive leverage combined with a mismatch between assets and liabilities. And there's only been really one recession that's been caused by something else. And you could argue that the 2000 tech wreck was not a leverage issue, okay? And it was not even an asset liability mismatch. And that actually led to a recession. The technology the tremendous drop in tech stocks, and then sort of the ripples through the economy. But literally, as we sort of study, at least the last 300 or 400 years of economic history, that's the only situation I can come up with where you had a major economic downturn that wasn't caused by wasn't linked to excessive leverage. And so I think it's a lesson that we have to learn, and we pay a lot of attention to it. And you're not always popular, when you're sort of at the peak and you start seeing leverage appear in different places. People will think you're too conservative and so forth when you pull back. Now again, this will sound gratuitous and it's not meant to or self-serving. We, in 2007, when we began looking at some of the instruments that were being issued, the so-called CIVs, and as you know, many bond funds and money market funds invested in these vehicles, and many of them were rated AAA, but when you sort of peeled them apart, there were components of them, these are structured investment vehicles, that had tremendous leverage, and we could not figure out how they could be rated AAA. It didn't add up, so we didn't invest in them. Right. Now, it cost us yield, and so there was a period where we were taking some calls from some of our investors saying, gee, your yields aren't as competitive as we thought they'd be. You talk about your cost advantage all the time and the depth of your fixed income team, but we're seeing better yields from XYZ firm. And so we were unpopular. And even our client teams, I was getting a lot of calls from some of our client teams about this. And it's just one of those lessons that you've seen when you see it play out over and over again, you just have to internalize it.
Yeah. Bill, speaking of technology, some would argue that you've got 6 of the major market makers that are all technology-related firms. And there's some concern that slowdown, transition, whatever, is going to have a fundamental kind of impact on the economy. Any thoughts there at all?
In terms of
you look at the Googles, a number of the other firms that seem to make the market as it relates to performance and returns and so forth. And I know through our West Coast office anyway that people are feeling that Northern California is kind of pitching at a pretty fast tone anyway.
Yeah, so I'd separate out returns and the economy a little bit because actually in the short run, economic growth and market returns really don't correlate that well. Again, valuation drives everything. So where I would agree with you though is many of those firms are pretty highly valued, and so you begin to wonder just how much more room do their stocks have to run. A lot of people have lost relative performance betting against them, but when you look at the valuations, it does draw you back. I think on the economy side, again, we're relatively sanguine about the next couple of years economically. We continue to believe there will be growth. We actually don't see a lot of recessionary signals. We see, actually in some ways, just the opposite. We're actually seeing the first bit of wage inflation over the last 6 months that we've experienced. And again, in different sectors, it's actually getting hard to hire people. And so we're starting to feel that ourselves as a company, but we're also seeing it among many of the portfolio companies that we own. That doesn't mean that we see the economy growing at 3 or 4%, though. We're still in this sort of hidebound range of 2.5%. I'm completely intrigued by a couple of our aspiring future leaders that we're going to get back to 5. I can't figure that out. But I do think there's by no means a guarantee, if you will, and you read this sometimes, that there's going to be a recession in the next 6 to 12 months. We just don't see it. Now, that doesn't mean we're Pollyanna and think that everything is rosy, but we actually think the conditions are more positive than negative for what I would say is continued muted growth. Right. And by the way, there's been a lot of, I can be sort of a glass half full, glass half empty on the economy. There's been a lot written about this. 2%, we'd all like to see it at 3 or 4. It'd be, create more jobs. It would do a lot for us. The one thing about this recovery that's very different is it's very unlevered. The consumer has been slower to add leverage to his or her balance sheet. I'm guessing, we believe economically that may be depressing broad GDP growth by as much as 0.5%, 0.75%. That's not necessarily a bad thing in that consumers aren't getting themselves back to the really high leverage that they had before the crisis. And, so maybe a little lower growth isn't a bad thing if it's a result of not being as levered.
Now, is that choice due to the fact that leverage is not available? In other words, they can't get mortgages, or?
So, I think, again, you guys know the mortgage market a lot better than I do. I think we've seen, obviously we've begun to really see that open up in the last 12 months in particular. And I think on the consumer side, there's, credit cards are still really available. I do think there are more guardrails there from the issuers. But interestingly, most of the decline in leverage isn't due to people not having access to credit. It's actually due to paying down debt. So you're seeing debt reduction more than you're seeing lack of credit availability, I think.
Because if you said that Americans have a lot more self-control today than they did before, it'd be a little bit harder to believe that.
I think that's probably fair.
Right. Let's switch topics for a minute, Bill, and talk a little bit about cybersecurity.
Yeah.
Not a topic that I know a lot about, but anyway, it seems to be pretty popular. And I think as we were doing our homework on you, there were a couple of points where either speeches you'd made, you said, this is one of the few things that keeps me awake at night. So curious to get your view on how Vanguard's addressing cybersecurity, how well you actually can safeguard against.
Yeah, so it's one of the things I think you guys saw in when you were doing the homework on this. We've been very involved in a lot of discussions in Washington around the regulation of investment management firms and financial services overall. And I think many of you have been following the debates and discussions about what are systemically important institutions and what are systemically important activities and so forth. And the government is really paying a lot of attention. We had the opportunity to testify just about the whole process. And toward the end of the questioning, and it was all around, it was an S&P 500 fund, a systemically important vehicle. Is it going to cause widespread systemic risk? I'm hard pressed to figure that one out. But at the end, one of the panel members in Congress said, what are you really worried about? And that's where my response was, if you really want to look at what the biggest systemic risk is to not only the investment management business, but to business overall, it's cyber. And, again, those of you who are involved in the technology side of things in any way, shape, or form have seen this up close and personal. Again, I'll go back to that, statistic. I said, in 2000, we were just getting our online capabilities going. We had a few 100,000 people registered. Today, 98% of all transactions done at Vanguard are done online. And so, and we're not alone. You know, all of the big investment firms would say the same thing. So this has become a virtual marketplace. And obviously, when you then back that, you know, link that to all the infrastructure and all the, you know, whether it's the markets themselves or the custodians and so forth, it's this vast electronic network that makes everything go. And so the cyber thing is really a big deal. And, you know, I'm you know, it's sad to say, but there are a lot of bad guys out there. Right. You know, it started out as sort of hacktivists, people who kind of wanted to cause trouble for fun, and then it turned into sort of cyber crime gangs, and, you know, Eastern Europe was particularly notorious for this. And then it's gotten into nation states now, and, you know, the nation states aren't necessarily all that interested in, you know, running off with your money out of one of our accounts, but they maybe are interested in disrupting the system. And so you actually can, you know, there are tools in place where you can monitor this and you can actually see this stuff going on. And in our security operations center, you know, I'll go down and sit there periodically and you'll see literally thousands of attacks every day. And so it really is, I think, the most important issue. And, you know, forget mutual funds and, you know, investments and banking products and so forth, and raise it up to the grid. You know, to think about just how reliant we are on, you know, basic technology today as a society. So all businesses could be affected by this. So that's sort of the bad news part of it. So what's the good news is I actually think people are really paying a lot of attention to this. So, you know, within the Treasury Department, so the Secretary of Treasury, actually the Undersecretary of Treasury, number 2 in Treasury, has been leading a task force on behalf of the government around cyber that really pulling all the government agencies together. And this is actually, we've actually seen some positive progress there. And so we applaud that. We want to see even more. You know, within our industry at least, there's tremendous cooperation. So, you know, Vanguard and Fidelity and T. Rowe Price and so forth, I mean, we go head to head every day and we're really, you know, we want to compete. But when it comes to cyber, there's no competition. And I was at a session with one of my peers from Fidelity recently, and I had to thank him for, I was sitting in our security operations center, and literally a phone rang, and it was Fidelity saying, we're undergoing a certain type of attack. You guys should be prepared, and here's what we're seeing. And I know we've repaid the favor many, many times over as well, but there's this tremendous network. Our industry trade association actually thought this was so important. We formed a group, a committee of the Investment Company Institute devoted solely to cyber, and we bring together all the chief information security officers on a very regular basis. And again, inside, you know, when they start talking about this stuff, competitive things just go by the wayside. It's all about making sure that our investors, our assets are being safeguarded. So I do think there's, and I know other industries are doing similar things, so I think it really needs that kind of attention. I would tell you, I don't know how many, it's hard for us to see you guys with all the lights here, but I don't know how many investors we have out there, but if I asked how many of you, for whoever you deal with, are employing two-factor authentication, I'm going to guess I would not get a huge response. And I would tell anybody, at least if you deal with us, sign up for two-factor authentication. And what's two-factor authentication is when you log in and you put your password on a separate device, you receive an email, a text with a code, and you have to enter that code within 10 minutes, or you're not allowed to access your account. It may sound a little bit like it's creating friction, but I'm telling you from a security standpoint, it's the single biggest thing you can do to prevent hacking in the retail consumer financial space. A lot of the banks already offer this. You know, we were one of the first investment firms to do it. And I would tell you, for any place that offers it, personally, I would sign up for it. I think you will get to even better technologies over the next 5 to 10 years, but right now it's as good as it gets.
Right. So the bottom line is you'll never have anything foolproof. But the question is the industry in kind of the fifth inning relative to investment and
Yeah,
deterrence, or where's the industry? We just
I think we're well into the middle innings on this in terms of understanding it and investing in it. Again, at our scale, I don't mind telling this audience, we're spending close to $100 million a year on this kind of on security. It's a huge amount of money. I would rather be spending it on cool new services, but it's a requirement at this point because, again, people are entrusting their assets with us. So, and I know the spend throughout the industry is commensurate with that. And so there's literally billions of dollars being spent on this. And again, it's an offset, if you will, to the tremendous convenience and efficiency and scale that the internet and electronic world have brought to us. But I think it's a really necessary offset.
Right. Before we segue into the couple of questions about leadership, the boomers are on the precipice of retirement, and you all are obvious. I think you're the largest 401k manager, aren't you today?
Yeah, we're the largest 401k manager in the world. Yeah.
So, how do you look at that? Is that are you kind of salivating about that, or is that going to be a challenge, or what's the opportunity there?
So, full confession, the boomers are near and dear to my heart. Those of you who are millennials or other generations probably are sick of hearing about the boomers, but I was born in I think the largest cohort, the year of the largest cohort of the baby boom. So I'm watching this with great personal interest. There's been a lot of speculation that when the boomers begin to retire in waves, and we're just starting that phenomenon now, that that's going to put downward pressure on the stock market. We think that's completely false. We don't think there's anything to it. I actually think it's it doesn't stand up to any kind of rigorous scrutiny. If you take a couple and both retire at age 65, there's a greater than 50% probability that one will live beyond 90. So we think with the boomers, you're going to see people living almost as long in retirement as as the number of years they spent working. The only way they're going to be able to make their savings last for that period of time is going to be to invest in asset classes that generate real returns, and significant real returns. So equities are going to continue to be a very important part of people's portfolios, even as they age. Now, how you deal with volatility and so forth, I think, is a whole separate set of issues. But there's no question in my mind that diversification is going to be just as important in retirement as it is outside. The other thing I think that's going to happen, and I would fault our industry a little bit on this. We've been all so focused on accumulation, but not as focused on the tools that people are going to need during decumulation. So I would expect a lot of innovation and new services and new products, frankly, that address the retiree market much more directly. And I think you'll start to see that, in the next couple of years in a pretty big way.
Decumulation. Interesting.
Well, so my parents are both thankfully alive. They're in their mid-80s. And I remember to this day when my dad retired, my mother, I think she was a little worried about what she was going to have to do during, at lunch. It was like, it was one of these, I don't really need your father around 24/7, but she was, they had grown up in a time where there were both traditional defined benefit plans and the beginnings of 401k plans. And so she looked at the savings and the defined contribution plan assets that they had, and she was like, we can't afford to retire, we're not going to be able to do this. And I said, Mom, you're forgetting, you actually still have an old-fashioned defined benefit plan that's going to pay some level of benefits. And so we sort of backed into it and said, yeah, you're actually going to be okay. My mother, by the way, is world's worst market timer. So, and at Vanguard, we're really anti-market timing. So I'm always having to sort of keep her on the reservation. But the one thing she was very focused on this retirement readiness. But if you fast forward to our generation and then certainly project out, unless you work for government or in the municipal side some way, it's unlikely that you're going to have a traditional defined benefit plan that pays you a stream of income for life. Most people are going to be, how much did you save in your 401k plan and in your personal savings. And figuring out how to make that sum of money last is a lot harder than just getting a check every month that just keeps coming.
Yeah, interesting. Let's segue into leadership. And by the way, too, we're going to give about 5 minutes at the end if anybody wants to ask a question of Bill. So if you're thinking of one, you'll have the opportunity in a minute. Per the introduction, Bill, you've been at Vanguard for 30 years, 1986, if I did that math correctly.
Yep.
How has that long tenured experience kind of impacted your leadership style, would you say?
I think I'm kind of broken at this point in that I couldn't work anywhere else. When I was interviewing at Vanguard, one of my great mentors and eventually my boss and my predecessor as CEO, Jack Brennan, he was interviewing me, and Jack was a tough interview. He was pushing on all the points on my resume and so forth. And I did get a couple minutes to ask him, and I said, what are you trying to create here? Jack was CFO at the time, and he said, we want to create a culture here where we have the intellectual rigor of Wall Street, but with Midwestern values. And that's kind of when for me, the light bulb went on, and I said, I hope I get this job. I really got to get this job. And because that really resonated. And so the beauty for me has been that I've gotten to live that for 30 years. And I think when you have a culture as strong as ours, and I give Jack a lot of credit, and I give our founder, Jack Bogle, a lot of credit, because they really established that right at the beginning of the firm. And Jack Bogle was always, he was really fond of saying in the early years, we've got to put the client first. And then in terms of the way we want to treat each other, the golden rule is going to apply. He was very non-hierarchical. And so everybody, no matter what their role was, you had to respect it. And then we began to evolve that notion into don't come for the job, come for a career. And so when you add all that up, it's a unique culture, and I do think it shapes you. And so I think those values, if you will, are the kind of values that you also try to lead with. And so it does shape how you interact with your own people. It does shape how you interact with clients and so forth. And I'm really thankful for it. From my perspective, as I said, I don't think I could work anywhere else now. When Vanguard gets tired of me, I'm just going to have to ride into the sunset.
Go manage your mom's money or something.
Yeah.
We came across this great quote when we were doing some research, Bill. Basically, you said, we're not Wall Street, we serve Main Street. Tell us a little bit about how that kind of reflects, your philosophy on leadership.
Yeah, so, the mutual fund business, as you know, was really all about democratizing investing. So if you go back, 30 years, 50 years ago, make it easier, institutional investing, if you will, was only available to the wealthiest cohort of Americans. And, some people would own one or two stocks, people of more modest means, but a real sort of portfolio wealth management approach was really only done for a very small percentage of people. And then the fund industry began to, get a little bit of traction. Fund industry had been around for a long period of time, but began to get a little bit of traction. There were some regulatory tailwinds that began in the 80s. Obviously, the creation of 401k plans and so forth, IRAs. And this whole democratization process began. So today, universally, there are 90 million investors investing in mutual funds. We're fortunate that probably, depending how you want to count it, 15 to 20 million investors are with us today.
Wow.
And, for us, it is everybody. Our client base looks like America. And so it's the way I think about it is nothing gets me crazier than when I'm talking to a reporter or somebody outside the industry and they'll say, so what's it like to have $3.5 trillion? And my immediate response is, I have no idea. It's not our money. And it's a really important idea. It is not our money, it's our clients' money. And our job is to serve our clients and help them achieve what they want to achieve. And so I think you take that exact same set of principles and you apply it to leadership. There's a former CEO of Herman Miller, the great furniture company, Max Dupree, who wrote a book called The Art of Leadership. And he has this whole concept of the servant leader. And I think servant leadership, it kind of parallels the way we think of treating our clients. I think people who are in leadership roles, their job is to clear the way so that everybody else can do their job. And if you think about the traditional hierarchical pyramid, I think it's completely upside down. I think the employee base should be at the top and the leadership team should be at the bottom, because our job is to clear away all the things that get in the way of people doing their work and doing it really well.
Interesting. Something else I learned when we were doing a little bit of background research on you, during the financial crisis, as you know, most Wall Street firms were laying off in droves, and yet you instituted a no layoff policy because you didn't want people worried about their jobs so they could focus on their clients. Tell us a little bit about how you came to that decision and how it impacted both your people and your clients.
Yeah, so in full disclosure, I became CEO August 31, 2008. Lehman Brothers happened September 15th, or the weekend of the 13th, 14th. So I had 2 weeks. I often tease my predecessor, Jack Brennan, with whom I'm still very close, that he's the greatest market timer in history. What did he know that the rest of us didn't know? But, this was happening, and, the markets were just going down, and, for us, our revenue is derived by asset value, right? Because we charge an expense against assets. So as assets are declining, your top line is retreating pretty quickly. And so there's no way you could cut costs fast enough to keep up with what the markets were doing. The markets from peak to trough dropped 55%, in a relatively short period of time, about 9 months. And, so we came to the conclusion pretty quickly that just laying people off to reduce costs in an ad hoc fashion didn't make any sense. And we didn't want people to be nervous about their jobs. So we had, as a team, a leadership team, we had confidence that as bad as the crisis was, it wasn't going to be the end of the world as we knew it, and we would come out on the backside. That was probably the leap of faith. Because right in the middle of it, I think a lot of people were like, this is the end of, Western capitalism as we know it. We didn't think that. We thought we would get out on the other side. And we wanted to be ready. And frankly, we wanted to have, people intact. So what we did is we told people, there will be no layoffs. Do not worry about your job. You still have to perform. You still have to do all the things that we expect. But focus all your energy on the client. Nothing else matters. And we'll worry about the financial side. That's the leadership team's job. And then, the second thing we did, and this is the thing I wish we'd done even quicker, was we really made it an imperative for the leadership team to get out and talk to clients in as many forums as we could. We actually held like little mini town halls for some investors. We got out to our 401k clients en masse. We did a lot of media, and nobody else was doing this. And again, I'm really grateful. Jack Bogle, who had retired from Vanguard in the mid-'90s, was a great voice out there, just urging calm. Jack Brennan, my predecessor, was out. Our chief investment officer, Gus Sauter, myself, a lot of our leadership team, and so we really tried to do that. And we really tried to attack the issue on both fronts, both the employee front and the client front. And I would argue that the decision to do that actually catapulted us out of the crisis and made us even more successful as we emerged. Again, we've had a lot of success these last few years in the marketplace. I think 1 out of every $2 invested in mutual funds the last 7 or 8 years has been invested at Vanguard.
Wow.
And I think a lot of that is the fact that we didn't pull back during the crisis. And we sort of tried to keep things operating with the client first and our employees first. And I think it really paid big dividends. So you learn a lot of lessons from that.
Mm-hmm. and not a tremendous amount of shareholder pushback or?
Clients were great. We actually, because of our ownership structure, and if you think about the expense ratio that we charge,
Right.
Assets are going down, the expenses haven't changed, so the ratio that you charge is actually going up. So we were proactive in putting that out to clients in a transparent way. We got actually a lot of positive feedback from clients. It's like, nobody likes to see their price raised,
Right.
especially when they're especially when their portfolios have dropped 25%. It's not really, it wouldn't make sort of common sense, but they actually understood it. And I give our client base tremendous credit for keeping a long-term perspective.
Yep.
And again, our track record since has been pretty good about reducing those fees and reducing them pretty quickly.
Right. Many companies have been enticed to relocate to other parts of the country, Texas, Florida. We heard a lot of good things about Philadelphia in the introduction between the weather and the Flyers, at least at one point in time anyway. But why have you been so committed to keep the company here?
Yeah, so I consider us in so many ways to be one of the luckiest organizations on the planet. We were founded here. Actually, our predecessor company goes all the way back to 1929, and just a few blocks up on Market Street, the Wellington Funds Group. And then when Vanguard split from Wellington in '75, we moved our headquarters out to the suburbs. But the benefit of being here has been fantastic from a talent standpoint. And again, I'll just tell you a story. 15 years ago, we were actually at a strategic retreat. And by this point in time, we had our headquarters here and our largest operation, but we also had a pretty good operation in Scottsdale, and we had an operation in Charlotte. And the planning team that was working on this, the momentum was, let's open a fourth site, maybe in one of those regions that you described, or a fifth site. And we were starting to march right down that path, and then we started to do a little bit more homework. And we realized how lucky we were to have such a presence in Philadelphia. Philadelphia produces, I think, the second largest number of undergraduate degrees per capita of any city in the country, and it's a close second. The largest number of graduate degrees per capita by a pretty wide margin. There are 108 universities, I think, within 2 hours of here.
More than Boston, huh?
More than Boston. And so the educational infrastructure is absolutely unbelievable here. And then, the mayor really did a great job describing the neighborhoods here. One of the things when you're bringing people here who haven't been here, they're always shocked at the choice. You can live in the city in these different, very vibrant neighborhoods. I think we have the most diverse suburbs of any major city in the country. And, it's affordable. So, when you look at that combination of tremendous, education at the graduate level and the undergraduate level, combined with all the livability of the city, it makes for a really powerful equation. So, today we're 15,000 people globally. And we have offices in Toronto, London, Hong Kong, Singapore, Tokyo, Zurich. Still a pretty good size operation in Scottsdale, still a pretty good size operation in Charlotte. We have 10,000 plus people here, and we're still growing.
So 2/3 of your workforce.
2/3 of our workforce. And again, on paper, if you were like a consultant from a strategic planning thing, you'd say, oh, it's not diversified enough and so forth. We wouldn't change it, and we don't intend to change it. We actually like hiring here. It's just been, I think it's really been a big part of our success.
Interesting. Last question. So anybody who has questions in the audience, get ready. We talked a little bit about the boomers earlier. There are obviously a few millennials in the audience. What's your view of that generation? Do you think they're going to become investors, savers? How do you think about that group relative to your own business?
Yeah, so we actually employ a lot of millennials, which is fabulous, and I'm actually very positive about the generation broadly. A lot of creativity, a lot of passion. One of the things we see is tremendous passion in terms of bringing, sort of their personal work in the communities and life into the workplace and combining it in a very symbiotic way. And so we're actually seeing some really cool innovations come out of some of our younger crew members right now. There's been a lot written, though, that they are more conservative as investors. And think about it, if you're a millennial, you grew up maybe watching your parents go through the technology wreck and the huge stock market correction there. Then you get a couple years of breathing space, maybe you're in college and the GFC hits. And I've got 4 millennials, so full confession, they lived through all this. And they're just more skeptical about investing in the market, so they're looking for safer things. The good news, though, is they're very willing to save. I hear a lot of people say, oh, all they want to do is spend money, and actually we don't experience that. We actually see people have pretty good savings habits. Obviously a lot of them are trying to pay down debt, which is a form of saving. Right. And the good news from an investment standpoint, although when you do the survey work, they do score out as more conservative than any prior generation. Because of the way 401k plans have evolved with automatic enrollment and default options, most millennials are going into so-called target date funds in their 401k plans, which is their first investment vehicle. And the target date funds actually have appropriate asset allocation for somebody who's 22, 25, 28 years old, or whatever the case may be. Huge exposure to equities, huge exposure globally, for that matter. So they're actually getting diversified portfolios, even though their risk profile would suggest otherwise. So I'm actually pretty upbeat, and I think once they get to see the power of what these portfolios can do for them, they'll become even more passionate about it.
Great. Okay, we've got a few minutes anyway. Do we have any questions from the audience for Bill?
Yes, my question is around cybersecurity. My name is Larry Stone. I'm the elected county assessor of Santa Clara County, California, which you know as Silicon Valley. I have 1.9 million constituents. We have 500,000 plus property tax payers in my county. I have an assessment roll of $385 billion, and we maintain, for example, 233,000 Social Security numbers. So cybersecurity is very important, and we spend a lot of money on that. I'm going to increase your sleeplessness now because last week, a junior member of my IT staff, in 10 seconds, hacked 2 what we call hard passwords, 14 digits and so forth, in less than 10 seconds. I've never seen anything like it. I didn't realize that we were that exposed by a junior member of a staff that could get into 2 very hard passwords in less than 10 seconds. So that's what's ahead, and it scares the hell out of me.
Well, you just increased my sleeplessness by at least several hours. I want to thank you for that. By the way, I do, the problem that you have, and I actually think your story really does illustrate this, is that the capabilities and the technology, if you will, of, breaking encryption is progressing as fast or faster than our ability to create, even safer situations. So, a lot of what we're doing is trying to figure out how to wall it off. So you'll hear things like network segmentation, much more rigorous access management programs and so forth. But, your point is correct. There's no perfect solution here.
It gets back to culture, and if you don't lay off your people, you probably don't have that problem. Just a thought. One more question?
Greg Hummel from Chicago, longtime Vanguard investor. Thank you.
Thank you.
The new president is in office, and you're asked to advise him or her on questions of change. Australia has a superannuation system. There are countries in the world that have sovereign wealth funds. What are some of the things that our new leaders should be thinking about as we have this baby boomer age phenomenon and frankly, investment more broadly, better ways to do things?
Yeah, so that's a great question. The Australian system, for those of you who aren't familiar with it, is a defined contribution system, but it's mandatory, and so everyone participates. I think it's the best system in the world, by the way. It's not perfect, but it's really good. So I don't think we could actually go from where we are to that system, but One of the first orders of business around investment and retirement for me would be to increase access so that every worker has an opportunity to participate in a low-cost, high-quality 401k plan. Today, because of the nature of the regulations and so forth, it's really prohibitive for a lot of small companies to offer 401k plans. And would not take a lot of legislation to actually make that a lot simpler and make it a lot more affordable for companies to put it out there for employees. So access would be probably the first thing I would address. More broadly, from a regulatory and tax standpoint, I do think the corporate tax system is way too complicated. I do think, and both sides of the aisle, I think, agree on that. They have very different approaches as to how they'd fix it. But I think simplifying the corporate tax code would probably do more than just about anything to create more consistent growth and sustainability of that growth. And I also think it would reduce a lot of uncertainty for companies, which would be a really positive thing. The third thing I think I would encourage, and again, this is a bipartisan comment, I'd encourage them to think really hard about infrastructure. I'm increasingly worried about infrastructure, and I think coming out of the crisis, we actually had an opportunity to take some of that stimulus money and spend it, frankly, more wisely on infrastructure, and we didn't do it, and I think we're seeing some of the consequences of that. And so that would probably be point number 3. And those would be the big things.
I think we're out of time. So anyway, can we get a round of applause for Bill?